account. It costs you $6,653. Okay, which right now you would be out that money right now, pretty much. It would be dead between time decay and the fact that where the market value is at, or excuse me, market price is at. This option would be worthless. Remember what I say, the $862.50, yeah, it's worth $2.55. So it's only worth $250. Considering you already lost $6,400 and almost all of it, you would just stay on that for 2 days and see what happens. Even like a $50 rally tomorrow would have you being able to sell it out and maybe get $500 back. So I would definitely wait on that one if you were to be still long that kind of a trade. If you bought the put for, it costs $6,349 at this point, since you could buy it, see, the thing is, it's still expensive because of the premium. It's 51. So you could probably say that this might be a good time to get back at that one. So I don't know. This is kind of iffy. It's right there on a borderline price. So remember, time decay takes a lot of value out of the put pricing. So at this point, you probably would want to just wait for it to expire and just take, or you could get out of it, but you could probably give it another 2 days. It wouldn't matter. If you sold 100 shares of Tesla short right now, you would be up money. However, you would have unlimited risk. And remember, he could say something crazy overnight tonight, and tomorrow the stock's $200 higher, and you would be out a lot of money. Then you're starting with 86,000 right off the bat. You'd be definitely being burned a lot. So, or you could sell the call for a credit of $6,653. But remember, you had unlimited risk. But right now, if you did sell that call, you'd be able to buy it back now for $255. Which, had you sold this call at that point, that would have been the thing to do right now, is to buy it back. You'd be making $6,400. Your money is done. Your risk is off the table. If you would have sold the 865 put for a credit of $6,349, well, in that case, you're screwed on this one because you're out all that difference. Hopefully you own the stock at that point. That's why high downside risk. It's unlimited. Remember, we don't like things like that. Or, well, you can do it, but you better know how to cover yourself still with that, or you're going to have some troubles with your margins, that's for sure. The call credit spread, remember, that was a short play. You brought in $590. That's a pretty good play. Getting out of it right now would not be a bad idea. The put credit spread, which would have been a long play, remember, you would be out the $691 on this one. Or actually, you'd be out 1,000 minus the 691. That would be the difference that you would be out on that one. The call debit spread, which is a long play, $590 is what it costs. You'd be making 1,000. So you'd be making $410 on that one. That's a good play. You can get out of it now and maybe only make $350, but still you'd be able to make money on that one. The put debit spread, which means a short of 691. In this case, you take that minus 1,000. That's the money that you would, the put debit spread rather, which we are short here. In this case, you would be up money on this one. And, we just have to see what the pricing here. I would say you might want to let that one go for another day or two if you were to have done that one. So we're going to do one more quick one. We're going to blow through this one and then answer some questions out there. Okay, so for this one, we're looking at Microsoft Corp, which at the time of the making of these slides, it was trading at $232. Today at lunchtime, it was around $241, $242. So really no market movement. This is where you're going to start to see where time decay really makes sense, because the numbers before are so big, it's kind of hard to look at. So let's take a look at this. If you were to buy the 235 put and go short, it would have cost you which is $800. You could have bought the call of 232.50, which would have been a long play for $752, which is $7.52. Or you could have sold the options, obviously, for the same prices, in which case selling the put makes you long, selling the call would make you short. It's the opposite. For the call credit spread, you would be short. You would be selling the 235 call for $6.20 and buying the $245 call for $269. The credit spread for the put spread would be selling the 232. That's this lower one here and this lower red. This is kind of hard with this chart because it was in such a rally that these call strike prices are up here. Here's your 245 call, your 235 call. So the put spread you can see here where you have the 232.50 put here and the 222.50 put here. That's where you would have remember, credit here, and that is also the long play. Conversely, for a debit spread, remember, remember where it costs you money up front. If you were doing the long play, you would be buying the 235 call and selling the higher call above it, the 245 strike price for 269. Conversely, for the put spread, you would be short, meaning you would buy the 232.50 put and you'd be selling the 222.50 put as well. So for these vertical spreads at expiration, your call credit spread, once again, you would be short. You'd be bringing in a credit of $351. The put spread, you would be long. You'd be bringing in a credit of $345. Conversely, for the debit, this is what you would be paying out for it. Now, remember that this pricing, unlike the other two examples, the market's only moved $10. It's not a very big move. So what would mean, in pricing wise, what would be the thing that would have affected these options the most? If you've been paying attention, time value. Remember, time theta decreases at a high rate the closer you get to expiration. So the value and pricing of these options would be the only thing that would be really affected the most, because there's no movement there. It's only $10. It's not that much of a difference in price. I mean, $10 is a decent move, but not when the stock costs $240. So in this case, if you bought the 100 shares at $232.90, now it's at $241.77. So it would have cost you $23,290 to get into this position, and then now it would be obviously up. The call would have cost you $752, and now that would be a debit in your account because you've been purchasing the option, okay, and that would right now be $9.17, so that'd be $917. So considering that you have 2 days left and you are up after a $10 move, about $100 and some dollars, $150, $60, I would say getting out of that call would be the right thing to do because you only have 2 days left. As far as buying the put, which gives you the right to be short, you're out $800. It's pretty much worthless. You would just let this go and hope that Microsoft really falls through the floor over the next 2 days. If you were short 100 shares, your margin would be super high. You would have your unlimited risk, remember, and you would be down you'd be down $10 on that position times 100. If you would have sold the 32.50 call for a credit of $752 and had unlimited risk, obviously you would be down on this one. Hopefully you own the stock. Otherwise you're going to owe, well, it depends if it rallies even more money because someone is going to be buying it from you at that strike price. The strike for the put credit spread, or excuse me, selling a put would be $800. In this case, you still have high downside risk, but this one right here, you would be up money because the market's been rallying. Since there's 2 days left and anything could happen, I would say take your money and run if you would have sold the put. For the call credit spread, being short, $351. In this case, you would be down a little bit of money. But see, here's the thing is that the spreads, the difference sometimes doesn't, the pricing moves, but the credit doesn't move and the debit doesn't move, because since the market didn't move, this really wouldn't change very much. So getting out of it, you might as well just leave it to expiration because the market hasn't moved, whether you're short or long very much. So the short one, you'd be out a little bit of money. You could maybe buy it back if you wanted to get out of it. But your difference of what you would lose or not lose would be slight. So you might as well give yourself that 2 days of time. Remember, time meaning till expiration, not because of the decreasing in price, because of the time value. Your put credit spread would be $345. And then your call debit spread, if you were long this, your debit of $351, you would have some value in this one. So you could buy it back, or excuse me, sell it back and make a little bit of premium because of the $10 move. The put debit spread where you'd be short the $345, you pretty much have exhausted your pricing on this one. So for the 2 days left, I would say you would give that more time. So remember that these strategies, if you want to learn how to maximize your options trading potential, there's ways you can do that. First of all, you use e-option for your stock ETF and ETF option trading. There's also their option strategy tools like Options Play that you can use, and you can use these strategies and try and apply them and see how time and also how certain things would apply and impact these strategies. Remember, we chose the 2 to 3 weeks expiration, showing you how the vertical spreads, even though your return on investment it's very high for the amount of money you take in, but you can have a lot of market movement. It doesn't matter. You're only looking for X amount of money, but the thing is you can make that in a very quick amount of time. The other plays, whether you're outright the stock or ETF, or if you bought the calls or puts, remember you need to have a big move in your favor or else time and other things will go against you. And also you have high capital outlays. You could put on a lot of spreads for the differences here. We're going to get to your questions in one quick second. Remember, there's a free paper trading account also at eOption that you can use to test your strategies. Your ETF and stock trades are free, commission free rather, and your options contracts are only 10 cents per contract. So questions about the webinar options strategies and applications. Remember, you can always learn more at eOption. Let's see. I got your questions. Let's see. Is this trading based on U.S. markets? Yes, these are all from the NYSE and the NASDAQ. Anonymous NT. So when you say you don't want to be long 2 weeks out on a call that expires 2/12. Okay, so here's the reason why you don't want to be long necessarily a call that's when it's only 2 weeks out. Remember, time, it moves fastest, where time decay will erode the pricing. So when you buy an option, just the buying of it means that price is going to erode. If it doesn't move, if the market doesn't move at all, the time value alone is going to make the price of that option go down very quickly. So let's just say it was 5 when you bought it with 2 weeks left. Within a week, it's going to be at 2 just because if the market doesn't move, just because of time. Okay, so you need the faster time is moving, the bigger market move you have to have in your favor to compensate for the money that you're losing from that premium. Okay, so let's see, what are the cons and pros of credit and debit spreads? Okay, the pros and cons of credit and debit spreads are super easy. The pros, no matter what, for both of them is that you have defined risk. One of the biggest things for, I don't care whether you're a bull, a bear, how you figure out when you want to go long or short, whatever market, you always need to define your risk. You always have a trading plan, have a value for your risk allocation. And this is the thing that this kind of trading strategy fits in that model perfectly, because you know 100% when you sell a credit spread, what is the most money you can risk. When you buy a debit spread, you know 100% the only money you can risk and lose is what you already put out. So you can't even lose. No, it's already out of your account. It's already done as far as you're concerned. The best thing that can happen is you make money and you have money that comes back. Now, as far as cons, the con is that if you use a credit or a debit spread to whether you're being short or long in your direction, remember we showed you how you can use a credit spread to be short or a debit spread to be short, and also conversely to be long either one. Depending on that, if you have a major market move, like remember, if you buy a stock and it goes to the moon, you're only going to make on your credit or debit spread, if it's a bullish one, that difference between either your credit or your debit. Okay. Whereas if you own the stock and it kept rallying like $100, you're going to be beyond your strike prices. You would realize all of that gain. So you don't have unlimited upside potential with credit and debit spreads, but the controlled risk factor is one of the most amazing factors and opportunities for any investor or trader to truly take advantage of because of defined risk. And then you know what your ROI is. So instead of putting up hundreds of thousands of dollars to buy Amazon stock, get longs from credit or debit spreads, and you don't have to put up hundreds of thousands of dollars. Now, of course, you're not going to see those big returns to the upside, but they don't pay a dividend. And you know what? If that goes down, you're out a lot of money. So you can control your capital much better. Let's see. I see no mention of risk regarding credit spreads. Wait, it's bouncing around. There's so many questions coming in. Excuse me. I see no mention of risks regarding credit spreads that go south and suddenly get early assignment on expensive shares. Okay, well, here's the thing is, when it comes to a credit spread, your risk is only the difference between the two strike prices, okay? So when let's say it's $10 wide. So if it's a 220 strike price that you're selling, and then you're buying the 230 strike price, okay, above the market, that credit that you take in, whatever that pricing is, no matter what, you're only risking $10 of market movement. It's always defined, okay? So absolutely, that is the risk, and it doesn't matter about assignment of anything or whatever, because you can only make so much on a credit spread and you can only lose so much. No matter what the market does, early assignment, you don't have to worry about it. That has nothing thing to play into that. Now, if you're talking about early assignment, when you have other positions on, like when you're naked an option, where you sold an option like a call or a put, that's a totally different story. And that's why we discussed how, remember, you don't want to be like those hedge fund managers that got, they're, everything handed to them on a plate, that's for sure. So remember to always define your risk. That's why you use options. You hedge yourself in market movements by options, and it's a cheap way to do it. It's basically insurance policies that pay off all the time. Now, sometimes they don't. There's also times where you don't want them to pay off because you're making money somewhere else, especially if you own the stock. Do you accept Canadian clients? You have to refer to the options trading desk. They'll help you out with that question. Do dividends have an impact on your liability when option trading? Well, absolutely. The dividends coming out can cause volatility in stocks, especially if they change them, like increase them or decrease them by a big amount. So that's how they would. As far as pricing and stuff, obviously volatility creates option pricing differences, whether up or down, depending on the increasing or decreasing of volatility. So yes, good question. Dividends do have an impact, but it could be slight, it could be huge. It totally depends on the move of whether, like, for instance, if they stop all of a sudden cut dividends or something, like not even just cut them, like completely cut them out, like that would change a stock's price and value for sure. What about leaps with e-option? There's your questions you have to talk to the trade desk about. When would you use a spread of only $5? That's easy. We were looking at stocks that have such volatility. So $10 wide is nothing. It was for pricing, when you're looking at Amazon and Tesla, stocks that are 800 to, multiple thousands of dollars versus a stock that's 55, if you have a stock that's trading like Coca-Cola around $50, then yes, absolutely. You would have spreads that are only $5 wide. In fact, a lot of times you can get some of your best value on credit and debit spreads with the tighter, options. So especially because people don't watch them as much, they're not as sexy, if you will, as some of the high flyers. So let's see, we still have a couple minutes for some more questions here. This is really good. You guys got a lot of good questions today. Is a credit debit spread also known as a straddle? No. Okay. Straddles and strangles are, remember, where you are simultaneously, those are vertical spreads as well. However, the straddle and strangle is when you have the same expiration. Okay. A straddle is when you have the same price, same strike price, put and call, and a strangle is when you have, there's a little spread between them. The only difference is that when you're buying those are directional plays. So you just want the market to move. When you're buying a straddle or strangle, you don't care which way it goes. You just want it to move away, especially when you're buying them, because time value will decrease that price no matter what, because the time value when you buy a straddle or a strangle, both options will be losing money, time decay, every single day. So the price of that option will be decreasing whether it moves or doesn't move. So price movement is super important. Whereas with credit and debit spreads, the market doesn't even have to move. All it's got to do is expire. So it either has to move or expire, and then what your risk and what your potential reward is, which it's only when it moves against your direction of your credit or debit spread that you're going to end up losing money, but your risk is defined. If it doesn't move or it moves in your favor, then you make money, versus straddles and strangles. Very good question, but that's a nice thing where you learn about time decay too, because remember, if you were selling a straddle or strangle, time decay works in your favor, but then you have unlimited risk. So that's a totally another topic for another webinar. Can you explain the option Greeks? Well, that would be a whole webinar in itself. Time decay is the theta. You should hopefully have gotten a little better understanding of how, when we looked at these options, how within a short amount of time, some decay a lot, like when you do the outright puts or calls, or when you're buying on an option, any type of options, versus when you sell them, time decay works in your favor with short amount of time. Now, let's just say you had an option that's 4 months out. Well, then time decay, you have a lot of time. So the time pricing isn't really moving. So if the market's not moving and just a couple days go down, your option price doesn't really move because of time decay, because you have 4 months out. Now, if you have 4 days out, like now we have only 2 left, or 1.5 going into, or 2 days left, 2.5 rather, going into option expiration. time decay is almost all gone, and whatever's left, it's going to erode very, very quickly. So if the market doesn't move, that's going to just, that premium, part of the premium will be gone. Then there's delta and a bunch of other things that those that we have to get into as far as how much the market movement goes. All right, so we're going to wrap this up now. I'm going to show you one last thing real quick. Really good questions. I'll try and answer some of these after we turn this over to Gina. But I want to remind you to check out my YouTube channel, Forex Trading Unlocked. If you like this webinar and the information you got there, I do all kinds of other presentations, and also remind you about checking out the book High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions. You can apply these option strategies with these candlestick patterns and have a way of helping to find you get some good signals. That's which you can find out by reading the book. And so for more resources for you, I want to remind you about eoption.com for more option trading resources. To watch more videos of options tradings, you can subscribe to their YouTube channel as well, eoption at YouTube. And then also get the, or obviously since you watched the webinar, you're going to be emailed a copy of it anyhow. And remember that their next webinar, mark your calendar, is Thursday, March the 4th at 1 p.m. Central Standard Time, bullish and bearish options strategies. Sign up at eoption.com/webinars. And thank you very much.
Okay, great. Thanks so much, Teddy. We really appreciate it. That was very interesting and informative. And on behalf of eOption, we'd like to thank all of our attendees for taking the time out of your busy day and for all of your questions. Those were great. And if you want to trade some of these strategies, don't forget to take advantage of eOption's low rates. We charge just 0 commission for online stock and ETF trades, and options are just 10 cents a trade plus $1.99 a contract. And we know some of you on this call are already account holders, but if you're not and you're interested in opening an account, just feel free to go to eoption.com and you will find buttons there to open an account, and it's pretty easy to get started. We also have a paper trading account, so if you want to try us out, try our trading platform, put your watch lists in there and your news and alerts, you can definitely give us a try with a paper trading account. You'll get $100,000 in virtual currency to get started, and that's free of charge. And a couple people in the chat room asked if they'll be getting a copy of this. And yes, we will be emailing all of the attendees a copy of this so you can watch it at your leisure. And you should receive that in the next few days. And it will also be on eoption.com. We have a resources and education page that has a lot on there. And it will also be on our YouTube channel. So lots of ways you can find a copy there. And we do have, I can't stress enough, I hope you'll go to eoption.com. We have all kinds of education on there for you. You'll find clickable strategy links with videos. So for example, if you want to find out about a certain spread or option strategy, you can just click on the link and it'll tell you all about it, as well as videos on how to use that strategy. We also have all of our past webinars on our website. And then as we mentioned, Options Play is our trading tool. It basically scans thousands of stocks each day and highlights option trade opportunities for you if you're looking for trading ideas. And that's normally $500 annually. And we do offer that free to all of our customers. And also feel free to give our trade desk a call. We're happy to answer any of your questions. And that number is 888-793-5333. Again, 888-793-5333. And that really differentiates us from other firms. I know there's a lot of firms out there where you can just use a trading app and it's really hard to speak to someone, but we pride ourselves that it's easy to get through to speak to a licensed, experienced broker, and we're happy to answer any of your questions. So if you have questions about a particular option strategy that Teddy mentioned today, or just how to use our trading platform or get started with our tools, we're always happy to talk to you. So give us a call. And as mentioned, we hope you'll check out our YouTube channel, and the link is on the page that you're looking at. And we just revamped that. We're pretty excited about it. We have all kinds of new playlists. So if you want to get into covered calls, you can click on that. You'll see all of our past videos on that. If you want to get into more complex strategies, you can also click on that playlist and you'll see all kinds of webinars come up. If you want to use our trading platform, we have all kinds of videos on how to get started and enter complex option strategies. So we hope that you'll check that out. And someone asked a question about the Greeks. If you go to our YouTube channel, we did do a series on the Greeks. We did one on Delta and Gamma and one on Theta, Vega, and Rho. So if you do go, you will see some videos there where you can get started and learn more about it. And as Teddy mentioned, we hope you'll join us for our next webinar. That's coming up in early March, and that will be sponsored by the Option Industry Council, and we partner with them a few times a year. So we're very excited about that one. You can go to our website and sign up at eoption.com/webinars, or we will be sending out some email reminders leading up to it. You can also sign up there. So again, thank you so much for attending. We know you have a busy day, and we appreciate you taking the time out of your day to join us. And be safe, and we'll see you soon at the next webinar on March 4th. Thank you again. Bye now.
Buy signal that was triggered right here. As you can see, this $21.50 area was our first target level that was reached. We had long positions on that we had executed back on the 8th. We had also gotten out of our first level, target 1, as I said last week, and then now it's been bobbling around. As you can see currently right now, it's very quiet. You have to remember, U.S. markets are closed. European markets will be closing soon. Asia, so the week is off to a little bit of a slow start. If we didn't have much action, and you got to remember there's Chinese New Year going on as well. So between those factors, it's probably going to be a bit of a slow start to this week. I wouldn't expect to see very much volatility. But you never know. Anything can happen, especially that's why be very careful if you're trading today. If you already have positions on, then I would say work them. Make sure you have your stops in place. Today is not a good day to enter a new trade, at least until this evening's trade when the Asian markets come back online and starting Tuesday's trade. Like I said, with Chinese New Year going on and U.S. markets having a holiday for not all of them, but some of them, there's not really going to be very much activity. So, but for the most part, since the banks are closed, they're done, especially for the currencies for the rest of the day. So what we are looking for, basically nothing today, and then with any luck, we'll see another pop up to this $21.96 area. That most likely will put a cap on the rally for the Euro-US dollar. What it really needs to do is get above this high here, which if it does, that would mean it does take out this $21.96. Should it do that, you may begin to see momentum build to the upside and press resistance a little bit more. The dollar index, as it's starting to sag, see, here's the thing, is we have a mixed bag of goods. The British pound, which we will get to next, is the second biggest weight in the dollar index. As you can see, the dollar bears didn't get much except for last Monday out of the euro. After that, there wasn't very much left. The dollar bears out of last Friday. And then today, as you can see, it's just only slightly lower on the day. So not looking for much today, looking for some follow through to the upside. So dollar index is not going to be the best gauge, especially when you see how the British pound is rallying like this. This has a long-term, medium-term, short-term, daily, and hourly trend is all bullish. Do not try and fade this. Eventually the top will come. However, with oil being strong and other commodities being strong, and since the UK no longer has to fund the disintegration of the EU in their financial system, that's probably giving a lot of strength to the pound versus many currencies, which it is if you look at the pound crosses. In fact, one thing you want to look at here is the British pound over the euro. See that? The British pound over the euro is making new move highs today. It broke out to the upside. That is why you're seeing the euro kind of weak against the dollar, as well as not doing much on today's trade. So this is showing you how much strength there is in the British pound. So I think this is since it's the second biggest weight in the dollar index, it's going to make the dollar index hard to use as an indicator as long as this is trending so fiercely. This, as far as long-term projections, how far can this go? Well, anyone's guess is on this one. The UK does have a lot of issues with lockdowns and things like that. So I think that for the most part, this is commodity driven and EU separation post-Brexit driven. I would look for the pound dollar to see a turn before you'll see it with the pound euro and stuff. So the pound is going to be probably a very choppy trade as it does develop a correction. You might start to see moves like this where we'll see a harsh sell-off and then get like choppy like this and then most likely not continue to trend higher, but develop a very wide range trade, which will be indicative of pound strength versus other currencies, meaning that if the pound is strong versus the euro, the Swiss, and other currencies, not so much against the dollar, you'll have sell-offs where when the other currencies gain a little strength, you'll see a nice pound US dollar sell off. But as soon as the pound starts to gain strength on those other currencies, that's where you'll probably have to look for a bottom with the pound US dollar, meaning that we will still probably continue to make higher move highs and higher move lows, which is indicative of what? A bullish trend. Be careful trying to fade this. Now let's look at the US dollar Swiss. As you can see, last week, except for Monday, there was really not much, or excuse me, Tuesday, there really wasn't that much of a trade that hammered this market. We did have a sell signal here, a short-term one, and this hit its target, actually. This low from last week at 88.90, this is going to be key support. I wouldn't expect much today because, like I said, because of the holiday. If it falls below here, then your target will be this level here, because this will be a key low, most likely because you're going to have basing because of the amount of trading that has happened in this area right here. So across here, I think around 88.32 to 38, this little support band, you're going to find a lot of support. So maybe we still dip down to there. This might be a good place to look for a buying area. It does look like the US dollar Swiss is starting to set a base. The overall trend is a bear, so use caution, but we've had signals giving the dollar some strength, and I think that you'll start to see, at least with some nice little swings like we had when it sells off, when dollar weakness comes into play. Be very careful. So keep your stops tight on your longs, and definitely be careful with your shorts, because this can grind higher. So we'll see how this works. Right now we don't have a signal. We hit our downside target last week. It's a holiday market right now. We're going to have to really gauge things more tomorrow, or if we get some decent trade that develops once the U.S. markets open in 6 more minutes. Okay, so let's cruise on over to Japan. Now, the yen, their markets were open today, obviously. You can see, look at this. U.S. dollar got a pop against the yen. Well, this is, I would say, probably because we have a good inverse relationship where, meaning that while, say, the pound and the euro could be strong against the dollar, and even the Australian dollar and New Zealand dollar, it doesn't necessarily mean that the yen will be. Especially with the rising price of oil. So remember when I said we have a commodity-driven trade with the pound? Well, now that we will no longer be exporting oil anymore in the U.S., that's also a big deal for Japan, because it limits their ability to get supply from yet another global carrier and producer, which puts also geopolitical tensions more on the stage for them, because we have very good dynamics between Japan and the United States, have for many decades, and even over the past recent 10-15 years, because of the fact that the administration is now cutting off oil exports and production in the U.S. This will put a strain on Japan, because obviously they're an island and they don't have oil. And as much as they have been going in towards the greener stuff, if anything, solar and wind-powered stuff and water-powered stuff has been very huge over there for decades already. But they have all kinds of other problems too. You got to remember that they have an aging population, and they are a big exporter. So no matter what, a lot of what they need the oil for and gas for is for ships and heavy equipment, which definitely right now are not being run on electric power, which would just cause, I mean, there's just the dynamics of it just don't work right now. We're not at that level of technology yet, but who knows? Maybe who knows what happens, and it can happen any day. It'll pop up with something that all of a sudden can run a big backhoe and a Caterpillar tractor for hours and hours and hours. So anyhow, this is why I think you're seeing this as far as fundamentally getting the dollar bull. We are making higher move highs and higher move lows, and now with this explosive move to the upside today, I would say that you're looking for a challenge of this high up here from a couple weeks ago. You can see that the short-term trend here continues to make higher move lows, higher move highs, but remember that the overall long-term trend on the monthly and the weekly is still bearish. We have become neutral on the daily. This is still gauged as an upside correction. Should we get a swing point through here at $1.577 and breach this level, I think you have a good chance of getting a whole dollar up to about $1.106.5. The slope of this trend is not too steep. It's almost a 45-degree, which is a relatively smooth slope for any short-term or long-term trend. Right now, we're still viewing this as a short-term corrective trend to the upside. We would need, obviously, a lot more time and price action to figure out whether or not it's a true turn in the market. It is bottoming and basing right now, though, with this type of correction, because this correction has been going on now for over a month and a half. So we'll go on the side of dollar strength when it comes to the yen, especially as long as oil is remaining higher. And also, you got to remember that the 30-year Treasury bonds, that's another market that has continued to pound lows. In fact, here's a quick lesson for you as a gauge for any type of currency direction with the U.S. dollar. When you go to forex-trading-unlock.com, go to the commodities under markets, you pull up the commodities tab, so bringing this index page up. When you toggle down, oops, wait, we went to commodities. I'm sorry, we want to go to interest rates or futures. You go to the futures tab, and you toggle down, and what this will have is some stock index and also some bonds. We start with the 30-year bond, go all the way down to the euro shots. Why do we have these things? Well, the euro, excuse me, interest rates are a function of currency pricing. This is the Treasury bond market. It has been trending lower now for months. Okay, this goes all the way back to August of 2020. So this is in a 7-month decline. Okay, now this is a big deal. This is the weekly. Here's the daily. The Treasury bond market has been slamming new lows now for weeks. As this continues, it's hard for the dollar to be too bearish because of the interest rate equation. The fact that the market settled on Friday at $1.6605, this is huge. 166.05 rather. This is a big deal. Any trading below this 168 level is definitely very bullish to U.S. dollar. So that's another thing that's giving a lift to the U.S. dollar yen. So as the 30-year continues to remain low, in fact, we can even check on this right now to see where it's at right now, because the electronics market should still, they may be, even though the banks are closed, this may be open. Let's see, $1.6501. Okay, yeah, that's right. They're not. The Globex is closed right now, so we won't see anything on. That's another thing too. The snap, because of the interest rates being closed for that extra day today, they'll open up this afternoon. That's when you might start to see some swinging action in the U.S. dollar yen, as well as all of the other currencies. Now let's look at the Australian dollar, U.S. dollar. And by the way, if any of you out there have any questions, you go right ahead and don't feel afraid to ask anything while we're going through this video still. We will be going back to the euro, but first let's finish up with the Asian zone. All right, Australian dollar, US dollar. We had a nice little rally here. This is another commodity-driven currency. So as dollar bulls try and fight and grapple with certain currencies, they're going to be really hard pressed with the Australian dollar, US dollar. As you can see today, we poked a higher move high after a lower move low. That puts us on the neutral campaign. However, I would use a lot of cautions being a bear. If you're a bear, I would use this 78.24 as your risk level. Any trading above here is very bullish. The trend for the Australian dollar in the long term is a bull, the medium term bull, daily. It's been neutral because it's been making, well, it's been short term daily up until the last week was a little bit bearish because we've been making lower move lows and lower move highs, which is indicative of obviously a bearish trend. But this is viewed only as a short-term bearish correction. So key off these pivots. Any trading above 78.24, this would be bullish. I would do not, maybe use call, do not try and sell in front of this one. If you want to get short in front of it now, this is your risk level, looking for some sort of a test back down here. Remember, we have this little upward sloping support line holding the trend intact. It's pretty much a 45-degree angle, which is holding that also up. I do not expect to see much of a slide off of this one. Should we take out this line, then the next level will be the 75.66 area. This would be a key failure level. If we do not take out the 78.24 and we end up falling down on support and taking out 75.66, well, that would be a lower move low after a lower move high and on a major daily basis, which would help us to really view this as a corrective trend lower that could have probably, I would say, the ability to get down to the 74, maybe even 73 even area. The only thing I think you have to watch about this is, in order for this to happen, for the Australian dollar, US dollar to get down to this levels, the 30-year bond is going to have to remain kind of around where it's at, not any big rally there. And then also you would need to see a sell-off in crude oil. I don't see that happening anytime soon. And if we do, it's just because of expiration. Remember that the futures on oil, they have rollover every month versus the financials, which have it every third month, which we are coming into rollover for the currencies coming up in the next few weeks. And we will be paying attention to that as it unwinds. So right now, a little neutral on this one. Aggressive bear only against those highs from before with the Australian dollar and the US dollar. Now we have the New Zealand dollar, US dollar. This is another tricky one too. It's kind of neutral. I would key off of this 71.37 level. A failure from here will have us back on the 70.94. And then we can probably see this correction being pressed down towards the 69 area. As you can see, we have this upward sloping support line keeping the trend intact. Even if we just go sideways, eventually we'll bounce off this and test it. That would take obviously quite a bit of time yet, a few months. But this one here is kind of locked in neutral. Short run, it's been making higher move highs and higher move lows. So we, like I said, key off the 71.37 area. A failure here would take us off the neutral to higher path and then put us back on the neutral to lower path. This is also commodity driven. We're waiting for a signal. We just don't have anything right now. So we'll see how things pan out after Monday's trading is over. So let's go to the US dollar, Mexican peso, because for all of you thinking about your spring break trips and how much it's going to cost and what have you, the nice thing is that if you haven't booked your tickets for Mexico yet, your deal on the peso is a lot better than it was in January. So hopefully you didn't try and buy the peso then, because you're getting basically almost